Hello everyone. Welcome to our channel Butela Technologies Ltd, Eswatini. We are so much excited to bring this forex trading full course, our first lesson, which is lesson number 1. This course will basically lecture you from scratch, giving you the basics on how to understand the market forex trading business. Then after this course, we will then start introducing the technical analysis, that how can you look the charts so that they make sense and for you to be able to make money. So currently, please be with me as I'm gonna be explaining a lot of different concepts starting now up until the end of this video. It's gonna be a little bit longer, but I'm pleading that you stay with me up until the end of this video. If you have the passion of being a full-time trader, you better listen to this video. Just spend 1 hour to make your life different forever. So we will begin our lecture. That what is forex trading? Guys, it is very much interesting to know that forex trading is the largest online market in the world, which exchanges up to $6 trillion a day. Previously, it was it started from 5.1 to 5.5. I last time checked, it was $5.9 trillion a day. The funds that can circulate globally to all the consumers. So it's the online market. So the online market, there is no specific building that around this direction, that's where you will find a building called forex. It's just based strictly on the internet. So there are a few objectives that we're gonna focus on as we are starting to explain everything into detail. So here are the things that I'm gonna talking about. I'll be talking about along this video. I'll be talking about the introduction to forex trading, the tools you need to trade forex, the basic terms you should know when trading, how to read currency pairs, how can one be part of the forex market, how to make profits in forex trading, is the types of currency pairs, how to pick a currency pair, the real factors that drives the forex market, the types of analysis in the market, the trading sessions, the types of traders, types of analysis, the brokers that I prefer personally. But before we begin, can you go through this disclaimer? Let me move my picture. Yes. Can you go read this disclaimer before you attempt to do anything pertaining our education? Take this disclaimer, value it. We are saying this to you if as you'll be taking all this course and going through our videos. Make sure that you have read and understood this disclaimer. That's what we are saying to you. Thank you. You can pause the video and read all the stuff. I won't go through it right now. So let's begin. What is forex trading? In forex trading, yeah, one is buying a currency and selling another currency at the same price. So guys, this is the biggest financial market in the world. Here we are trading real money, cash, real money, because we are investing real money. Then we withdraw a real cash into our personal accounts. So here there is no central market. It is an OTC. You see, so the price, it is set by the interbanks, like the banks in the Wall Street, the federal banks. In forex trading, the price, it fluctuates based on which currency is stronger than based on which currency is stronger at that very moment. So there are few trading centers which are I've read about somewhere, and I know they do exist. In the Switzerland, in Japan, United Kingdom, Singapore, just to name a few, and also the Wall Street, the Nasdaq. Yes, those are the trading centers that I know. So for forex, it's a very wide and a big community. What do we mean by a very big community? We mean that for forex trading, we it has so many departments. You see, there are money market funds, exotic investments, treasury bonds, options, futures, ETFs, commodities, cryptocurrency, government bonds, real estate, and mutual funds. All these types of the forex community. The most of them are famous, and some are not famous because they require one to have a very big capital in order to invest in one of those uh, forest communities. I'm familiar with the ETFs, the options, the futures, cryptocurrencies, the commodities, and the real estate. Those are the forest communities that I'm familiar with. But I won't advise you to go for options. Usually, people, they've been ill advised that the options, they are easy to make money. So as a beginner, I don't advise you to go and invest with those community. They are, though they are leveraged, you can also benefit, but there are many chances for you losing a lot of money. Okay, guys, let's proceed. The benefits of forex trading. Forex trading is good because at first, forex trading, it is a 5 days market, meaning it's 24 hours, 5 days a week, from as early as Sunday evening and Friday at night. The market opens from Sunday evening and closes at Friday midnight. Usually it's around 11 p.m. On weekends, the market is not operating. So yes, it is traded 5 days a week. On weekends, forex is not traded. It is highly liquidated market, and it is also predictable if you have enough knowledge. So you can also choose to focus on very few pairs. Yes, you can choose, because trading all the pairs will make one to lose focus. So another thing, another benefit is that it's a very quick speed of execution. It is also dealing with leveraged products. For instance, someone, you have a $100 account. The good leverage for your account, it can be 1:50 and below. I wouldn't advise you to use a leverage that is higher than 50, like 1:100, 1:200. Above 50, it's no longer good for you because you just will wipe your account in a very short space of time. So with $100, you can make a lot of money, meaning that's it, that the benefit of trading forex. You can start with $100 and make a lot of money, which is, yeah, it may make a lot of money. While in other businesses, you need a capital that is reasonable. So another benefit is that there are no commissions. Forex can give you high returns. The low trading capital can also give you maximum returns. So uh, you can also make money even if the conditions are not good for the economies in the world. For instance, currently in 2020, there is a pandemic called coronavirus, COVID-19, the acronym. Uh, this in this current situation, many people have lost their jobs. Many people they have closed their businesses because the the consumers have been advised by the head of states to stay at home since there is this pandemic, and for people not to catch this virus, they have to isolate themselves from public. So a lot of businesses have been affected and a lot of people have been affected, but the traders, they are always trading at home. They are always trading at the comfort of their places. They have never been affected other than being hit harder by the wrong predictions. So another thing is that you can gamble with forex. Yes, you can gamble. I don't like to say this, but I've no choice. I have to list it because it's already there. So you can gamble with forex. You can start with as little as $50 and you trade the news and you make something like $500. That's possible. That's possible. We can't deny that fact. So another thing, it has a high leverage and can be dangerous and be beneficial at the same time. So forex trading, it is high volatility. It is true that 90% of traders, they lose their money. It is very, very, very true. Very, 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 very true. So having said that, yes. So let us shift to the next topic, which says, who are the participants of forex trading? The participants are the brokers and the dealers. The brokers and the dealers are the middlemen. The middleman. The broker is a middleman between you and the market. So there is a broker in between. Another participants are the retail traders, which is you and me. You are a retailer, the consumer, and you go via the broker straight to the forex market. Another participants, the multinational companies, the big companies, the commercial banks, they provide the trading volume, which leads to the liquidity being increased. So the money changers, the big institutions, the hedge funds and investment firms, the government and central banks, either investing or withdrawing. So they also have the power to drive the market, because if they invest a lot of money, the movement in the market, it is simply being affected. And also if they withdraw a lot of money, there is a huge difference in the market. So this leads us to another topic, which says, what are the tools that you need to start trading forex? You need a computer, you need a laptop, you need a smartphone, and an internet connection, a fast internet connection. So you can use those gadgets. Why did I started with the computer and the laptop and I ended up with the smartphone? It is because it is not easier to analyze with the computer, and I mean it is not easier to analyze with the smartphone, but with a computer, a desktop or a laptop, it is much easier because the charts are clear. The charts are very clear. Let me show you what I'm talking about here. You see, the charts are very clear here. You see, you can easily see that. You can easily see that now the market is bullish, or the market is consolidating. So That's the reason it is very wise to use the 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 laptop or the computer. So you also need a good trading platform so that you can start your journey of trading. I personally recommend MetaTrader for all the beginners. That's the friendly trading platform for someone who is still new in the market. There are also other trading platforms like the MetaTrader 5, the Trading View, like also the trading platforms for different brokers like XNES and XM Global, just to name a few. But basically, it is very wise for you to use the MetaTrader 4. Also, you need to choose a reliable broker, this is something very important, because um, you find that a lot of people, they tend to use brokers, and the brokers they are using a when they want to withdraw. The withdrawals, they take some time to arrive in their personal accounts, and even if they can send the email to the support group, that broker it takes some time to respond. So to use a reliable broker is very important. And another thing, you also need a trading desk like my desk, where you'll be trading. Why do you need a trading desk? You also need a specific place so that you conduct your trading. Why? Because trading, it requires your time to analyze. It takes some time, and you don't need a disturbance once you started to analyze your market. Since here we are dealing with real money, so it is very important to to use your tools that your tools that will be reliable. So another thing, you need knowledge and experience. I would like to appreciate you to open this video and seek for knowledge, because you can never make money without knowledge, and you can never make money without experience. Also, how will you acquire experience if you're still new in trading? You'll acquire experience after my course, and you will be able to start trading on a demo account and maximize your profits. So this leads us to another topic, the basic terms, the basic terms to know when trading forex. So the basic terms one need to know when trading forex. So I'm sorry about the disturbances. Yes, I'm sorry. Uh, the basic terms, it's liquidity. When we talk of liquidity, we mean that of this is the amount of the interest in the market. I'm sorry. Can I pick up this call? Okay, thank you so much for understanding. Yes, I'm sorry. I'm very sorry for the interruptions. I'm so very sorry. Yes, I have to attend to the call. Um, Another term is the bull market. The bull market, it means the market is going upward, meaning the trend is upward. Usually they say, it is sometimes said, the market is going long. Also the bear market, that's the downward trending market, or sometimes they call it the market is going short. And also a pip, which is a smaller currency unit pair, smaller current unit measurement. And also the leverage, this ability to use a small sum of capital to control large amount of money to your personal account. The margin, that's the amount of money available into your account to use per trade. And also the asking price. that is the price in which one buys the base currency. The bidding price is the price in which one used to sell the base currency at the current market price. Let's check here. You see here this. Okay, let's remove this thing. Okay, okay, sorry. You see, this is the bidding price. This is the asking. No. This is the asking price because it is the price that is one uses to buy. And also, okay, here these are just to cut it short. These are the price I'm talking about. Yes, these are the prices, the two different prices, the asking price and the bidding price. Yes. Let's go back to our notes. So the asking price is the price in which one buys the base currency, and the bidding price is the price in which one used to sell the base currency at the current market price. So the spread is it's the difference between the asking price and the bidding price. This depends solely to the broker that you are using. For instance, let's check here. It's my calculator. Let's count. Here it is 1.9083 minus 1.9067. No, I've eliminated a zero up there. Let me start with the blue one. 1.19067 minus 1.19083, meaning here the spread is $16. The spread for XM Global, because in this case I'm using my real account on XM Global, which is the spread is 16. So that's how we check the spread. So there is this thing which is called the correlation. This is the extent in which one currency moves in the same direction or mainly the opposite direction to another currency. They may be called positive correlation when they go together, like the euro dollar and euro JPY. They most of the time they go into the same direction, but the euro dollar and the GBP JPY, they go opposite direction, which we can call, in this case, they are the negative. I'm sorry for the spelling there. Yeah, they are called the negative correlation. So there is also what we call a base currency. It's the currency on the left hand side, and also the code currency. It is the currency on the right hand side. Here is what I'm talking about. You see, it is euro dollar. Here, let's focus here. Euro dollar. The euro is the base currency. The USD, it is the code currency in this case. So let's this takes us to another part, which is the leverage and margin. So as you can see, the percentages are the margin requirements, and also let's say you are a beginner, you are trading with a $100 account and you have a leverage of 1:10 into your account. It means that you can control the amount of 1,000 US dollars in total. So you can please visit our video, one of our videos. They explain in detail about the margins. Yes. So this takes us to another topic which says how to correctly read the currency pair that you're trading. Yes, please guys, you should clearly note that all the currency pairs are written using 3 letters, where the first 2 letters they refer to the country and the last letter it refers to the currency name. For example, the JPY, the JP it means Japan and the Y means the yen, and this is pronounced as the Japanese yen. So at the moment, the most traded currency is the US dollar, and the most traded currency pair is the Euro US dollar. They usually pronounce it as Euro dollar. And so yes. So US dollar. Why is the US dollar so important? What's so important about it, the US dollar? Yes, this is the most significant and liquid currency. It is regarded as the safe haven currency in the world. So if the world economy is collapsing, we see with the US dollar, that's because the US dollar should shoot upwards. It means that the world economy is collapsing. So it is sometimes called the greenback. It is also used as a monetary reserve for central banks. It's the reserve currency actually globally. So it's one of the major reserve currencies in the world. Hence, the many transactions are done with the US dollar. If, for instance, you are exchanging some goods uh, from your country to somebody's country, for instance, to a foreign country, you will be exchanging your goods using the US dollar as a form of exchange of your goods. So that's a that's why we say it is a the monetary reserve for central banks and is one of the major reserve currencies in the world. So many currencies they are paired against the dollar. So let's talk briefly about the euro. So this is the currency pair that is mainly used by the Eurozone members, and it is also an alternative to the US dollar. So this currency pair, it makes up to 57.56% of the dollar index. Do you know the dollar index? Yes, the dollar index. Just find out about the dollar index. You will understand more about the euro. Then the Japanese yen is also one of the safe haven currencies because when the economic times are very bad, it shoots upwards. Mainly, it fluctuates. It fluctuates based on the economic state of the Republic of Japan and its trading partners. It is also called the low yield currency. Low yield currency. One of our videos uh, has explained uh, briefly on the low yield currencies. So let's go to the Swiss francs, which is abbreviated as the chief. It is a popular safe haven currency. So this in Switzerland has the most. Swiss francs is the yes. So the Switzerland has the most stable economies in the world. Yes, Switzerland is one of the most stable economies in the world. So the movement of this currency is mostly based on the external factors. This currency is friends. So whenever you face for why am I telling you briefly about this each currency? It is because before you start trading, you need to check the news, analyze your chart, because most of the movements, they are also a response to what's going on around the world. The GBP, the Great Britain Pound, which is called maybe the GBP, it is also known as the pound sterling. That's the cable, which is its nickname. So London is one of the key trading centers, and this currency pair is one of the most widely held reserve currencies in the world. So it takes us to the Australian dollar. Australian dollar is mostly known as the Aussie. Aussie. This is a commodity currency. Sometimes it correlates with gold, because mostly in Australia they deal with mines, maybe sometimes agriculture. It's more like a very economy that relies on the natural resources. So this pair is mostly used as a proxy dollar for JPY. So so this so the Australian economy, we can say it is tied to that of China. You see, yes. So that's the Aussie. So the Canadian dollar, it's also known as the US loonie. So its economy is tied to the United States dollar. So the US absorbs most of its exports in Canada. So Canada is one of the major oil exporters. So whenever you are thinking of trading the Canadian, any pair with the Canadian dollar, make sure that you have observed the news and you are well updated on what's happening around the world when it comes to oil. So that's the Canadian dollar. Another pair is the New Zealand dollar. Yes, NZD, the New Zealand dollar. It is also known as the Kiwi, and its economy is closely tied to the Australian dollar. Hence, they rely on commodities to drive economic growth. So here they rely mostly in the agricultural products and the meat products, the beef production, things like that. They are mainly based on agriculture. So that's where their economy is lying. So guys, let's explain these magic numbers. Yes, for instance, the euro dollar, there is what you call the bid price, and which is the buying price, and there is what you call the ask price, which is the selling price. You see, if you can observe the numbers, here it's 1.09574, then the selling price is 1.9586. Why do you sell with a higher price instead of selling with a lower price? So here, yes. So why is it like this? It is because, okay, but why at the high price and sell at the lower price? It is because that's the way they collect the money from the retailers. So you see, so the lot sizes, let's go to our chart. You see here, that's the volume. This is what we call the lot sizes. It helps you to know exactly that how much do you wanna risk or you want to gain from the market. So here the lot sizes. For instance, it's from 0.01 up to 8 in this case, up to 8. So that's where what we call, sometimes they call it the volume. That's the lot sizes. Here it's where the stop loss. For instance, if you place a trade here, if you place a trade here, if you place a trade here, you see, you are placing a buy. Then after placing the buy in this direction, the stop loss should be below this area and the take profit should be above the price, you see. So that is why every time when you are opening a trade, you start with the stop loss and you do the place the take profit, then you can execute your trade. We use the market execution order. You sell by market price or you buy by market price, you see. So that's the asking price, that's the bidding price, you see. Bidding price we buy, the asking price we sell. So I think you get this thing now, but we will get deeper to the chart when we are explaining more about the, how do we call this thing, the technical analysis. We will try to go deeper and emphasize, because once you are well versed with the technical analysis, you will win every day in trading, trust me. Okay, let's continue with our, so this takes us to the another topic, that the ways to get involved in the forex market. It is very simple to get involved. You can trade the spot market, you can go short or long term. There are short and long term traders. You can trade the currency options, the FX swipes, the spread betting, physical exchange, ETFs, which is the exchange traded funds, ETN, the exchange traded notes. Yes, how to make profit in forex trading. It is very, very simple. If you want to make profit in forex trading, it is like this. If you place the, for instance, you place your okay, from the, okay, let me take this here. If for instance somebody placed the trade here and the market price, they placed a buy, for instance you placed a buy here and the market price, the price moved from this area, it went long to this direction, this person will make a profit. That's how you make profit. But if the market goes against you, if you say this is a buy and the market decided to, for instance here you place a buy and the market decided to go down, you make a loss. So that's how you make profit on forex trading. So in trading, when your capital is appreciating, when the trade is when the capital is appreciating, for instance you deposited $200 and now you have $300 daily, that's how you make the profit. So our trading, it is always based on the strength and the weakness of the currency. There is a base and the core currency, you see. So we sell the strong currency and we buy the weak currency. For instance, you see a seesaw. A seesaw is like this. If I am putting this thing on top, that is heavier than the other one at the other side, you see, it will go down. So we sell strong currency, then the weak currency goes up when the strong currency goes down. I think it makes sense. So let's check our chart here again. You see here, it is the euro dollar, meaning here the euro dollar has lost some value against the US dollar has lost some value against the euro. That is why the dollar has been going long, bullish. So meaning the euro economy is currently stable as compared to the US economy. Let's go back. So how do you know? So how no, you should know how to calculate your profits, guys. It's very important. You can, okay, please go check one of our videos, but excuse me, I advise you that you should know exactly. For instance, the market was here and you want to check the number of points here. You see here the points from the price up to here. The system is able to tell us that it is 647 points, meaning that if you have opened a very small position, you'll make $3. So you can also use the the pip calculator. It is available on the internet. It is free of charge. So people, I know people, they like things that are free, like my video. Okay, like let's get into the forex pairs. In the forex market, there are major pairs. The major pairs are the most popular among the traders. They include the US dollar and the currencies from the well-developed countries. Most of the liquid pairs in the forex, excuse me, most of the liquid pairs in the market, they have a low spread. That's the advantage of trading the the major pairs. They are also less volatile and more predictable. The major pairs. Major pairs may include the euro dollar, USD JPY, GBP dollar, the dollar Swiss francs, the dollar Canadian dollar, the Aussie dollar, and New Zealand dollar. That's the major pairs. We also have the minor pairs and the exotic pairs. Exotic pairs. So let's talk about the minor pairs, which are also called the cross currency pairs. So these pairs, they don't have the dollar in it, the cross currency pairs, which means they are pairs without the US dollar. So they are stable for more experienced traders. These pairs, they are more volatile and they are less liquidity, meaning they have a higher spread than the major pairs. You see, so they may include the euro chief, the euro JPY, the GBP JPY, the euro GBP OZ, New Zealand JPY, Canadian JPY, just to name a few. These have very high spread. So take note that the minor currency pairs are without the US dollar. Always note that. That's why, as a beginner, I would advise you to take the major pairs and trade them. In that way, you will make a good money. You will not blow your account with just one position. So let's look on the exotic pairs. Exotic pairs, they are also known as the emerging market currency pairs. So they consist of the US dollar combined with a currency of a smaller country or small economy. So the exotic pairs have the least liquidity in the market. They are the most stable for long-term traders because if they decide to go long and be bullish, they just go long, and the long-term traders, they can hold for a very long time. So let's go now and talk about the floating and fixed price. Yes, so the currency pairs are not fixed and they are allowed to float freely in accordance to the market movers. For example, the US dollar, the euro, the GBP and the JPY. There is what we call a fixed regime where all the currencies, the currency prices, they are pegged to a to the value of another currency, and the advantage of this is that their stability is maintained, like the SGD and HKD. Now let's talk briefly about the picking the right currency pair if you want to start trading. So if you want to pick the right currency pair, you look at how often that currency pair trend and range. So how liquidity or volatile is that pair? For instance, like the euro dollar, like I've just said, the most famous currency pair that is traded is the euro dollar. What kind of news will be more significant for this currency pair? What is the best time to trade this currency pair? Things that you should look. What is unique about the currency pair? How will the movement of the pair affect the other pairs that one is trading in the market? You remember we talked about the correlating like the pairs. If this pair is bullish, the other pair will be bullish. Or if this pair, that's the positive correlation. If the other pair is bullish and the other pair is bearish, that's the negative correlation, meaning they swap the direction. So you should always consider that before you take this pair, note that it doesn't affect the other pair, because someone may also may buy euro dollar and sell euro JPY. That means that the trader, it's still that trader, he still need more lectures on trading. So you should know that how will the movement of this pair you are choosing will affect the other pairs that one is trading. So also you should be aware about the central bank that has more effect on that particular pair. You should be aware. That is why whenever you're choosing the pair, be knowledgeable that if I take the GBP dollar, I will check the news calendar that what are the news we have today pertaining this pair. If there are a lot of news, you just eliminate that pair and look for other pairs which have less news, or not unless you are a fundamental trader, you can take that pair. So this takes us to the key points to consider. The key points to consider, the most things that you need to consider the most in trading. Only pick and learn one currency pair first when you're starting out. I've mentioned that before and I'm repeating right now. Because you want to start trading and you're still new in trading, make sure that you pick one currency pair or two at most. But I advise you to pick one currency pair like the GBP dollar or the euro dollar. Just pick one currency pair because you're still studying. Once you are used on analyzing that particular pair, then you can add few pairs. But basically, if you still struggling to, at least you want to have 5 digits or 6 digit figures in your bank account, focus on the major pairs, because those pairs have a very low spread, they are very volatile, they are predictable. I've just mentioned before all those things. So do not trade too many currency pairs when you have become even if when you are an experienced trader. Trading is not all about trading all the currency pairs. Like, hey, I want to trade a 50, 20 or 30 something currency pairs. No, trading is about analyzing the market and get quality signals. That is what you call good trading. If you trade, you get money. Not when you trade, you are donating more money to the broker. That is not acceptable. So the another thing you need to consider, the different pairs will always have different behavior and different volatility in the market. So the different pairs, they require different strategies. Yes, so my stop loss for USD JPY won't be the same at the same, we won't be the same points or the same pips with a GBP dollar or GBP JPY. So if I'm using a certain strategy, it won't be the same as the strategy that is used by my friend who is also trading. It takes us to the factors that drives the forex market. Yes, I'm sorry. The factors that drive the forex market. So the economic data, which is the NFP, interest rates, inflation rates, many traders they use indicators to trade the economic data. These indicators, they are leading economic indicator and also the lagging economic indicators. So we have a video that explains more about strictly indicators, the list of leading indicators and the list of lagging indicators. Yes, you can also comment in the comment section below so that we repost the information that you specifically need, because we are here to supply all that you need so that you can be profitable in the market. And also the other factors that drives the forex market are the political events like the elections, the commodity prices, the central banks, technical levels, societal events, the stock market, natural disasters, the supply and demand. But all of these factors evolve around the supply and demand. There are above factors like the natural disasters, stock market, societal event, technical events, central banks, commodity prices, the political events, the economic data. They all evolve around the supply and demand of the market. So there are some fundamental insights you need to be aware of. Take note that when the country's economy improves, this is going to cause the country's the, 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 yes, this is going to cause the currency of that country to go up. So it starts with the consumer confidence. If the consumer confidence is good, the businesses they increase production activities, meaning that the companies will hire more people. That way, the economy will also increase. The stock market currency will go up then. So these are the fundamental insights you need to be aware of. So we will talk about the trading sessions. We also have another video because in the forex market, it is very important to understand these trading time zones, because some of the currency pairs are good to be known, or are good to be traded at the specific times. These currency pairs, there is Sydney, Tokyo, London, and New York session. I usually trade the London and the New York session because here in the South African Standard Time, the New York and the London and the New York sessions, they take place during the day, and the Sydney and Tokyo and they take place during the night in our time. So you should know exactly which currency pairs to trade at specific times, because most currency pairs, the good times to trade them is the time when they are overlapping. For instance, the London session will start at 9 a.m. in my current standard time and ended up at 1 p.m. But from 1 p.m. to 2:30 p.m. it's the overlapping time. That's the exact time you need to trade the GBP and the dollar, because in that time the the time zone is overlapping. It has reached an end and the other time zone is beginning. So the currency pair is too much liquidity. So the overlapping time zone is a Euro Asia, a US London overlapped, something like that. So must be aware of all those things. So there are also types of traders. Types of traders. Yes, there is a scalper. A scalper is someone who wants to hold a trade for seconds, even minutes. They are trading with 15 minutes time frame, 1 minute time frame, 5 minutes time frame, and 30 minutes time frame. So this trading type is not good for somebody who is busy. This trading type, it requires someone to always stay focused on in front of the desktop or in front of the computer. So it has a high cost of trading because you're always opening your PC, your internet, and the data are being consumed by your gadget. It's a very stressful way of trading because your emotions are always bubbling inside of you. So though the scalpers, they usually make the most money, but are the ones also who loses the most money. Yes. So there is also what you call a day trader. A day trader is someone who's only trading 1 hour, 4 hour, and for 1 day. The time frame is 30 minutes, one H1 and HF4. Here there are no overnight open positions. The person just open a trade, like I just said, I'm trading the London Virgin. I open a trade at 9 a.m. But if up to 5 p.m. the trade is not on profits, I simply close because I'm a day trader. So though here there is relatively less screen time as compared to the scalpers. The scalpers, they are always in front of the laptop checking if profits or losses, and they are observing the market. A single tick of the market they are observing by other people. So there is also what you call swing traders. They hold for several days to weeks. They trade with time frames H1, H4, D1, weekly, and monthly. And this is suitable for busy professionals like some of us. So this kind of trading method is suitable for it, but it needs one to focus on the technical and fundamentals. So there is also what you call a position trader. A position trader is someone who can hold for weeks, months, even years. They mainly focus on the fundamentals. When you talk of fundamentals, we talk of the high impact news. They have the least amount of screen time and they focus mainly to win-lose ratio. Like for instance, when you talk of the win ratio, we will talk of 1 is to 5, you see. So if the person is betting with $10, let's see, the person is expecting to get $50 instead of that. So these traders, they focus to this ratio. So that's how it goes. Yes. So ladies and gentlemen, this topic takes us to okay, let's go to the type Types of entry orders. Let's go to the type of entry orders. There is called the market execution order, where the orders are executed just right now at the best available price, available time, the best available time price at that particular time. And there is what you call a limit order, which is the pending order. Here executes orders to either buy or sell at a more favorable price. And it is also called what you call a stop order. It is also a pending order. The good thing about the limiting order and also the stop order is that they can be deleted. But the market execution, you can never delete them. So let's check here. You see the market execution, you buy now, you sell now. Once you buy or you sell, you can never delete those orders. And also the pending orders, there is what you call the buy limit, sell limit, the buy stop, and the sell stop. For it, let's talk about the buy limit. For instance, the market is moving from this direction upwards. You see, no, the market is moving. Okay, we're talking about the buy limit. The market is moving downwards. You see, remember this line. Yes, the market is moving downwards, and we place the order here. When the market reverses upwards, this order will be triggered and you will make profits. And if we're talking about the sell limit, is that when the market is moving upwards and we place the order here in this candle. When the market reverses downward, the order will be triggered and we make money. You see, then there is also what you call the buy stop and the sell stop. Here, for instance, we're talking about okay, let's say focus on this line. If we talk about the sell stop, we place the order here in this price. When the market is bearish and up to this direction, if it reaches this price, this order will be triggered and a sell position will be activated. So that is called the sell order. If the market is, we place the price here and the market is from this direction and it is going upward, it is bullish. So when the market reaches the market price where we've placed our trade, the order will be triggered and we will have a buy position running in good profits. So that's how we use these orders: the buy limit, sell limit, the sell stop, the buy stop, and also the sell stop. So these are pending orders, but if we use the market execution, you sell by market price and you buy by market price. Do not be confused, because other brokers, it is also written instant market execution. So you must be aware of that also. So I've explained all this. So there is these types of market analysis. There is what you call the fundamental analysis and also the technical analysis, the sentimental analysis. I will briefly talk about the fundamental analysis and the technical analysis. The sentimental analysis, I won't explain it further today. Here on the fundamental analysis, the main focus is on the market moving in the economic indicators. So they may include the consumer confidence, the producer price index, that's the PPI, the consumer price index, the CPI, the retail sales, the trade balance, the economic data, the gross domestic product, which is abbreviated as GDP. So mainly these events that controls the fundamental analysis. If someone is interested in trading the fundamental analysis style, you need to be mainly focus on the news at all times. So central banks, you need to pay more attention to the US Federal Reserve Bank, the Bank of England, the Bank of Japan, the European Central Bank, the Swiss National Bank. Why are we giving you these banks? It's because for you to trade the fundamentals, you need to know exactly what how are the banks uh, doing in terms of interest rate, the GDP, the consumer confidence, something like that, because all those announcements are being released by mostly the banks. So you need to pay more focus and pay more attention to all these banks. So the special terms for the central banks, that's the hawkish, those banks that are positive about the future, they keep the inflation rate very low so that their currency can appreciate. There is also another term called the dovish. Those are the concerned about the currency, the currency to depreciate. So there is what you call intervention. Intervention is when the bank it withdraws money or the banks pumps in more money. That situation it causes a great movement in the market as a whole. So you also need to be aware of that. There is what you call the monetary policies. In the monetary policies, what you call the contradictory monetary policy, which is also the same as the hawkish side. It focuses more about the positive move of the market and also the loosening monetary policy or expansionary monetary policy. So when the inflation rate increases and there is a fast economic growth in the central bank, it raises the interest rate, which also causes the currency to rise. So that is very, very, very important. So guys, how to spot a trend or reading a chart? Um, let's go here to check. Uh, for instance, this is an uptrend. Okay, we can say that this is a trend line. When the price is sloping upwards, it means it's an uptrend. When the price is sloping downwards, it means it's a downtrend. So the technical analysis is mainly focused on trading the market based on its history. We draw the trend lines, the support line below, resistance line, support resistance line upwards, which is called support resistance zones, where we observe the history of the market. Then the market always respect its history. So it's what we call technical analysis, because we study the history of the market, then predict the positive movement of the current price. So we will have a video specifically teaching you about how to analyze the chart, how to uh, read the chart, and all these lines should make sense according to you. We will have a specific video for that. So the trend has got some stages. The trend has got some stages. The trend, it is called the initial stage. At the beginning, it's called the medium stage. At the center, where mostly the market used to consolidate in the middle, and upwards, it is called the final stage. So always make sure you don't buy when the market is at the final stage of a trend, or you don't hold a position when the market is still you don't hold a buy position when the market is starting to go short from the final stage of the trend. make sure that you sell at the final stage of the trend, or you buy at the initial stage of the trend. In the middle of the trend, you can do either you buy or you sell whenever you see a breakout. But let me proceed. We will have another video to deeply put an emphasis towards this. So there are type of brokers you need to be aware of. There is what we call the dealing desk, which is the market makers, the electronic communication network, the ECN brokers. Sometimes they say the ECN brokers are the best. Let me not involve myself to that. Yes, because I'm not a financial advisor. There is also what you call a straight through processing. That is the STP. So how to open a brokerage account? So if you want to open a brokerage account, you choose a broker of your choice. You pick the account type. Usually the standard account is the most famous account. Then after you fill up the form will be given by the broker, where you will have to enter all your credentials. Then you submit your personal information, that is the identification documents and proof of residence. Then you wait for verification. After you've been verified, you fund your account. They will give you the details of your account. You download the MT4 platform in your PC or in your cell phone or your tablet. Then you start trading. So that's how you need to open a brokerage account. But it's been noted that most people, they don't focus more on the best broker. Instead, they look for a broker with high leverage, like 1:2000, something like that. They also go for the lowest spread. They also go for the lowest capital, meaning the minimum deposit, $1, $5, $2, something like that. They also go for the famous broker. A broker to be famous, it doesn't mean that the broker is the best in the world. It means the sales managers for that broker, they are good marketers. They are good marketers. So you should always bear in mind that if the broker is famous, it doesn't mean it is the best. So you need to give yourself time to check up the broker, test the broker, and then utilize the broker. After you are used to their platform, you can start trading with your real money. So yes, you should test your broker. Yes, the slide. You should test your broker. You look at the trade execution speed. If it runs or on loss for more than 3 seconds, it's not a good broker. Change that broker. You must change that broker. Also observe the withdrawal speed. If you withdraw on Monday and you don't get your funds within 3 to 5 days, it means that broker is a problem. Change that broker. Also, the broker, if we say is a good broker, they should be able to respond to the customer inquiry very fast. The customer service should be of a good quality. So if the customer service is not of good quality, change that broker. So you compare the prices of various brokers. You must use more than one broker. Like myself, I'm using 9 brokers to trade. So you test their demo account and software to familiarize yourself with their software. So there are things you need to do before you go to trade a live account. You should learn all the basics and the fundamentals. 2, you should develop a strategy that suits your personality, and you should have a trading plan. You should practice on your demo account. You should start with a small live account. Learn from your mistakes. By doing that, I am sure you're gonna make it. You're gonna make it. Then for basics of technical analysis, please feel free to go check our next video, where we will be teaching you how to analyze, how to read the market, how to draw the graphs, how how to draw how to read the shapes of the market, or everything. We'll have another video, the basic technical analysis video. Please check our next video. uh, please check our next video. You will get everything you need in that video, and that is where we will start business of trading. After that video, I am sure you will be able to analyze on your own, to trade on your own, to do anything pertaining the market. You study those pairs, you can do anything pertaining analyzing. After checking that video, please check our video, our next video below, that talks more about technical analysis, analyzing the market. Thank you so much. Goodbye.